Hi, everyone. Welcome to this week's edition of What's Driving Token Prices. I'm your host, Katie Talati, Director of Research at Arca. For those joining us for the first time, I'm responsible for analyzing and evaluating digital asset and blockchain opportunities for Arca's funds. As part of our research, my team and I identify token prices and the market events that act as catalysts for price change. Based on our research and market events over the past week, here are some notable token price movements and what we think drove these moves. As a reminder, this commentary is not intended to be investment advice, investment research, or an investment recommendation. Please consult your investment professional for your own circumstances. Well, we have been on a roller coaster the past week. So let's dive in. I've got some juicy updates for you guys. So we can start off with Euler Finance. So DeFi project Euler Finance suffered an exploit early this week to the tune of $197 million. The project, which offers tranche pools for lending and borrowing digital assets, was attacked using a flash loan attack, which is basically when a user takes out a flash loan, which in DeFi, it's basically when you take out a loan and return the loan within the same transaction. Usually when that happens, you don't have to post collateral. And so a lot that, this used to actually a couple of years ago, probably 2 years ago or so, this was a very popular way of like attacking DeFi protocols and managing for the attacker not having any outlay on spend. So basically when they usually do a flash loan attack, they make the loan and then they simultaneously manipulate one of the markets in some way to make money while they only essentially spend on like the gas or MEV to put through the transaction in this case. So Euler security after this attack is being highly scrutinized as it was touted as a highly audited protocol with audits from Satora, Holborn, Solidified, ZK Labs, Sherlock, Omnicia, and Pentest Partners. Early investigations believe that the attacker exploited code that was modified in a recent upgrade. So a lot of people are really criticizing Euler and these audit firms because they didn't really continue with the security checks to ensure that, things would be suitable going forward. So upon announcing the exploit, the Euler token has knifed down about over 60% and stayed down there. Well, if you haven't noticed this week, the rest of the market has rallied quite a bit. And then in addition to that, TVL on Euler has fallen from about 260 million to just over 11 million with, a lot of people with remaining assets withdrawing them. So unfortunate to see this DeFi project fall, and hopefully we'll have more information soon on the attacker and how they made the exploit happen. All right. Next up is Radiant Capital. So Radiant is they call themselves a money market fund, but they're essentially also a lend borrow protocol. They're built on the layer two scaling solution called Arbitrum, and they're gearing up for the launch of their V2 this week. So this project basically promises to pay out real yields and stablecoins in ETH, and they're soon going to be upgrading their tokenomics, so users have to hold the RDNT token in order to receive yields. So the new version is also going to introduce new omni-chain versions of Radiant on other chains and migrate Radiant's protocol to Layer 0's omni-fungible token standard, which essentially makes the protocol more composable across other chains. Radiant Capital's TVL currently sits at about 137 million, but it could grow if their cross-chain expansion is successful. With this news, Radiant is up about 4.6% on the week. All right, next up we have HBAR or Hedera. So Hedera is an enterprise-focused layer 1 protocol. They actually suffered an exploit last week to their smart contracts, shockingly. So specifically, a user figured out how to send assets from other users' wallets to their own account by exploiting the Hedera smart contract service. However, once the attacker tried to move these tokens to a bridge on Hedera, presumably to move them to another chain and sell them, the bridge operators recognized the attacker and froze funds. While the Hedera team investigated this issue, they chose to pause the mainnet for all users. A patch was made and the network was turned back on in about 2 days. I guess the important thing kind of here worth noting is that Hedera is run by a council of like 21 members, and it's kind of been potentially criticized as being a little too centralized. And this mainnet pause is basically an example of how, in this case, it helped save funds, but it clearly showed how centralized it was. It's very unusual for a layer 1 to just pause all of the mainnet like they did, but they did it anyway. And even with this exploit, the HBAR token is up 4.4% on the week. All right. So last up, we've got this fun smorgasbord of events to describe to you. So strictly, I know these are not tokens, but I think there was a lot of confusion around what happened the last 5-6 days. So I really wanted to just like lay it out all here for everyone to understand and have a clear picture of what went on. So obviously, the events of the last few days have not just impacted traditional markets, but they've also trickled down to stablecoins, banks, and even Bitcoin. So we are going to start with early last week, Silvergate Bank, which, if you recall, there's two major banks in crypto that are crypto friendly and have accepted majority of crypto clients. That includes funds, exchanges, counterparties like OTC desks, and that's Signature and Silvergate Bank. So early last week, Silvergate Bank announced it would wind down operations and liquidate its bank. Basically, it's been rocked for the last several months. Following they had a banking relationship with FTX and Alameda. And they'd seen a lot of withdrawals starting in November of last year. So a day after they announced that they were winding down their operations and essentially just like giving depositors back their money, Silicon Valley Bank, SVB for short, announced for completely different reasons that they needed to raise cash via an equity offering to shore up deposits. So just to give you background again, SVB is a very concentrated customer base. They basically serve small businesses, venture capital funds, startups, more mature fintech firms. And so like they don't really have any retail customers the same way like a Bank of America or JP Morgan does. So basically what they did is they had managed to, invest about a really large chunk of their deposit assets, like around 40%, into longer dated treasuries. So they made a lot of these investments back before the Fed started hiking rates in the last year. So what happened is that they were facing potential liquidity problems. They decided to sell these longer dated treasuries, and they took a loss of about $2 billion. Yikes, right? Because back then interest rates were lower, they're now higher, so those treasuries are not worth so much. So really problematic in that. And basically because of this, they decided that they announced that they were going to raise some additional capital to fill this hole just in case. It was a just in case situation. So this was like Thursday morning of last week after Silvergate announced on Wednesday that they'd be winding down. So this spooked everybody, particularly a few large VC investors who essentially instructed their portfolio companies to withdraw assets from SVB. This basically triggered a run on the bank. So a bank run is typically when basically everybody tries to take all their money out at once. And as we know, banks rehypothecate the money that you deposit with them. They don't just hang on to it. They take it and they loan it out. They invest it in treasuries and other things. So SVB was not able to meet withdrawals. And then very early Friday morning, what happened Friday morning was that the bank officially collapsed and the FDIC actually took over the bank and its operations. So now we get to the fun part, which is the crypto-related stuff. So a number of crypto-related businesses had deposits with SVB, really high-profile places like BlockFi, Coinbase, but the big one was Circle. So Circle is the issuer of USDC, the stablecoin that you see over there. USDC, is backed 1-to-1. They provide monthly reporting and audits on, their assets and stuff. They had spread some of their spare cash across a couple of these smaller banks, such as Signature, such as SVB, and others. Now, basically, what kind of came into effect was that a lot of people got really spooked that Circle didn't have enough assets to back their stablecoin. The team actually released a very vague statement on Friday evening that they had 3.3 billion stuck on SVB, but didn't really quell the fears about, oh, we're fine, we're 100% backed, we're fine, and it's all redeemable. And then following this announcement, Coinbase announced that they'd shut off redemptions between USDC and USD. So that really just incited all kinds of panic. So what we ended up seeing was like Friday evening into Saturday morning, you saw USDC go from $1 to 85 cents. So it essentially broke its peg. A lot of, very scary for a lot of people. Finally, on Saturday, Circle managed to make an update and said that they, in fact, could cover 100% of redemptions. And USDC did eventually move back up to its peg. But that was very unusual to see. It was really interesting because USDC is so integral to so much DeFi and just so much of the trading landscape that actually it caused a lot of problems. People couldn't settle trades over the weekend. People got really scared because, for example, a lot of DeFi loans are backed using USDC. So basically, for Or even thinking about like MakerDAO. A lot of the DAI is backed by USDC. So, for them, if your collateralization ratio falls like so much, like 15%, which was unheard of on a stable coin, that was not something people had foreshadowed. And it really led to a lot of potential like cascading liquidations, all kinds of issues. So this really was stressing a lot of people out. So thankfully, USDC returned to its peg. But actually, the final and best part of our story kind of comes to Bitcoin. So on Sunday, if you also missed it, is when they announced that on Sunday they announced that Signature Bank, the other crypto-friendly bank, was being closed by the FDIC. And so now essentially that was the end to all the potential crypto-friendly banks. But as I said, the fun part of the story is that basically why did crypto and Bitcoin in the broader market rip starting Sunday? So after the federal government and FDIC announced Sunday that it'd be bailing out SVB and making all depositors whole and closing Signature Bank, any users that have been burned by these banks and stablecoin issuers over the last few hours turned to Bitcoin. So a reminder for those of you that are new to the space, we don't talk a lot about Bitcoin here because it's generally not the, center stage asset for the week, but Bitcoin was born out of the last financial crisis in 2008 when banks were bailed out and money was essentially printed out of thin air to compensate. Bitcoin was designed to be a hard money that couldn't be rehypothecated by a bank, that was supposed to be a safe place that you could store your assets and be this kind of hedge. It was designed as an alternative currency to USD. It was purposely made outside the banking system to avoid its influence, and it was meant to be completely, transparent and peer-to-peer. And so literally the setup that we just had the last 5 days was the perfect storm for Bitcoin. At one point, it was up to $26,000. I think it's now trading back around 24.5K. But this week was really Bitcoin's, time to shine. I believe on the week it's up about 13%, but as I said, I think at one point it was up closer to almost 20. And as you can see here, we have a nice chart where it dipped on the initial news of the sell-off of some of the banking issues and then ripped on Sunday. So Bitcoin, this is why we have you. Thank you. And that's all I got for you guys this week. Thanks for joining. I hope you enjoyed our insights. Tune in here next Wednesday at 1 p.m. Pacific to hear what's driving token prices.